During the January 2026 volatility, they reportedly profited over $500 million, building short exposure equivalent to 484 tons of silver, with that exposure valued at over $1.5 billion. That tells you something important. Size is present, sophisticated actors are active in the volatility, and the market was liquid enough for large players to press positions while smaller participants struggled to survive the swings. At the same time, the exchange itself becomes a player, not by choosing winners, but by managing risk. A margin increase from 22,000 to 25,000 is not a small change for participants running multiple contracts. Multiply that by hundreds of contracts, and the capital requirement jumps into the millions. That forces behavior. It forces liquidations. It also forces the market to reveal which positions were supported by conviction and which were supported by cheap leverage. But institutions also watch the physical side. They watch vault data, delivery notices, and the subtle distinction between metal that exists in a vault and metal that is actually registered and ready for delivery. On the COMEX, the category that matters for immediate delivery is registered inventory. Around February 3, 2026, registered silver was shown near 104.06 million ounces, while eligible or private storage was shown around 296.73 million ounces. That sounds like a lot of silver. But here's what most people miss. Eligible does not mean available. Eligible means metal meets exchange specifications and is stored in an approved facility, but it can belong to someone who has no intention of delivering it. Registered is the portion that is specifically set aside as deliverable against futures contracts. Now look at the delivery ledger, the part of the market that feels almost archaic. Contracts can stand for delivery. Someone can stop the delivery, meaning they are the buyer taking metal. And in late January and early February, the stops numbers were not whispering calm. On January 30th, the ledger showed 633 contracts stopped. On February 3rd, it showed 190. Each contract represents 5,000 ounces. That means a day like January 30th implies over 3 million ounces tied to delivery activity through the exchange mechanism. This is not a signal you ignore if you're trying to understand the paper versus physical divide. Meanwhile, London's data paints a different kind of picture. At the end of December 2025, London vaults were reported to hold 27,818 tons of silver, valued at $64.4 billion, roughly 927,254 bars. That's enormous. And it's also exactly why the paper market can look stable until it doesn't. Big numbers can lull participants into assuming availability. But inventories are not the same as float. Metal can be pledged, allocated, encumbered, or strategically held. It can exist without being offered. And that gap cannot persist forever. It can persist for longer than most people think, because financial markets are very good at manufacturing short-term substitutes. Paper claims can be rolled, settlement can be netted, positions can be offset. But when enough participants want delivery at the same time, or when financing conditions shift, or when trust in smooth settlement weakens, the gap starts to matter. Think of it like airline seats. An airline can sell a large number of tickets based on a model that assumes not everyone shows up and not everyone uses every option. In normal times, it works. But when too many people arrive and demand a seat, the model breaks. And suddenly the ticket and the seat are not the same thing. In silver, the futures contract is the ticket. Registered deliverable inventory is the seat. Let's slow down and make the contradiction even clearer because the details matter. When silver was running above 120, the move wasn't just speculative excitement. Moves of that magnitude pull in every category of participant: short-term trend followers, options, desks hedging gamma, commodity funds rebalancing exposure, and hedgers who suddenly face uncomfortable mark-to-market. Liquidity looks abundant until it is needed at the same moment by the same side. Then it can vanish. A sharp fall like the one into 86.60 doesn't require that everyone change their mind. It requires that a large portion of positioning was dependent on leverage and short-term financing. When the exchange changes margin, it changes the cost of holding risk. The same position that looked manageable at $22,000 of margin per contract becomes stressful at $25,000 when you hold dozens of contracts, and when volatility is simultaneously increasing the daily swings. At the same time, the physical world does not reprice instantly. A refiner doesn't stop processing because a futures price fell. A manufacturer doesn't pause production because a candle printed red. A wholesale bar doesn't teleport from one vault category to another. Physical supply and demand respond with delays. And they respond through different channels: premiums, delivery schedules, leasing terms, and inventory decisions. That's why a paper crash can coexist with physical firmness. It's also why you will often hear experts contradict each other in the same week. One expert points to the futures chart and says, the bubble burst. Another points to delivery and says, stress remains. Both can be right because they are talking about different layers of the same market. The viewer hears conflict. The institution hears a map. This is a critical distinction. The futures market is designed to provide price discovery and hedging, but it is also a leverage engine. A small amount of capital controls a large notional exposure. In the space of 48 hours, silver did something that isn't supposed to happen in a deep, liquid global market. It traded above $120, and then it was printed at $86.60, a 26% drop that looked like an air pocket. Not months, not weeks. 2 days of violent compression that erased what most investors consider a lifetime of price movement. And here's the part that breaks normal expectations. A collapsing paper price is supposed to ease pressure. Cheaper price means less demand, more supply, calmer markets. But in silver, the paper price can fall while the physical pipeline stays tight because those are two related systems that do not always move in sync. One is a number on a screen. The other is metal that must be located, financed, refined, shipped, insured, and delivered. They said the silver market could never split like this again. They said after decades of exchange reforms, clearinghouse risk controls, and modern transparency, the market would never be forced into a visible contradiction. Yet the contradiction is right there, hiding in plain sight in the space between futures, vault reports, lease rates, premiums, and delivery ledgers. The institutions already understand that difference. They act on it early. They position before the crowd, even notices that the headline price and the physical reality are telling two different stories. And when the rulebook shifts, when margins rise, when liquidity thins, when leverage becomes expensive, the crowd sees only the candle. The institutions see the plumbing. What I'm about to walk through isn't a theory. It's a pattern you can track with dates, numbers, and the kind of boring market mechanics that most people skip. But those mechanics are where the risk hides, and where the opportunity to understand what's happening lives. Welcome to Channel Name, where we decode what matters before it becomes everyone's headline. If you like analysis that follows the data instead of the noise, you're in the right place. And if you're listening like that wise elder who only speaks when it counts, you already know what to do. Drop a comment with where you're watching from, because this story isn't just about silver. It's about how modern markets reveal stress. Now, let's reconstruct the event. The late January move didn't appear out of nowhere. It was the final snap in a sequence that began when silver started acting like a market that had too much leverage on one side and too little available liquidity on the other. On January 30th, 2026, the headline was brutal. Silver plunged 26% to $86.60 after trading above 120. A move like that is not normal in a market people use for industrial hedging, for jewelry flow, for institutional risk management, and for inventory financing. A commodity can be volatile, yes, but this was the kind of drop that usually requires a forcing mechanism. That forcing mechanism had a name, and it was written into the rulebook, margin. Weeks earlier, on December 29, 2025, the exchange increased margin requirements for the March 2026 silver contract by $3,000 from $22,000 to about $25,000. In the same window, silver futures experienced an 11% intraday drop. When margins rise, it's not a moral judgment about the market. It's a mechanical reality. Leveraged positions become more expensive to hold, and weak hands are forced to choose between posting more collateral or liquidating. Here's where it gets interesting. A margin hike can cool a runaway market, but it can also trigger forced selling that creates the appearance of supply. The screen price falls, the headlines proclaim a crash, and yet, in the background, the demand that matters, the demand for deliverable metal, doesn't necessarily vanish. Sometimes it intensifies, because lower screen prices can actually pull forward physical buying by those who can still access financing and logistics. So the central mystery is this: how can silver crash on paper, while signals inside the delivery ecosystem continue to flash stress? To answer that, you have to zoom out. Silver has a long memory, and the market has seen this exact style of fracture before. In 1980, silver became a symbol of what happens when concentrated buying meets a market with limited deliverable supply. The response was a rulebook response. Exchanges tightened requirements and changed trading constraints, and the market broke downward in a way that destroyed leveraged longs. The result wasn't just lower prices. The result was a lesson. Market structure can override sentiment. In 2011, silver ran hard again, not because of a single corner attempt, but because global liquidity, monetary policy, and investor psychology aligned. Silver surged toward $50, and then the same pattern appeared. Margin increases in rapid succession, forced selling, and a fast collapse. The result was not an extinction of physical demand. The result was a divergence. Coins and bars carried premiums, retail products went into backorder, and the paper price told a cleaner story than the real-world availability. In 2020 and 2021, the world saw disruptions that exposed fragile supply chains. In precious metals, refineries, shipping, and inventory management became choke points. Even when the quoted price looked orderly, physical products became harder to source quickly at tight spreads. That was another reminder that price is the output of a particular marketplace, not a universal truth. Now in 2026, the same playbook is showing up again. A fast upside move draws in leverage, volatility expands, the exchange tightens margins, weak hands are forced to sell, the paper price drops violently. But the physical system has its own constraints and its own reporting. And that's where the split becomes visible. So who is positioned in this environment? It isn't just retail traders watching a chart, it's institutions and large traders who understand where the leverage is hiding and how policy shifts can move markets. Consider the reporting around Shanghai futures in China. That's useful when conditions are stable. In stress, that leverage becomes an amplifier. When the amplifier is turned down through margin hikes, the sound changes immediately on paper. The physical supply chain, however, is more like an ocean liner. It turns slowly, and its constraints show up as frictions rather than fireworks. Now let's talk about what those vault categories mean in plain language. Eligible inventory is like cash sitting in a bank vault that meets the bank's standards, but it belongs to clients who have not put it into the ATM network. It exists, it's real, it meets the spec, but it's not automatically available for withdrawal by anyone with a claim. Registered is like cash loaded into the ATM. It is positioned for immediate use in the system. So when registered silver is around 104 million ounces, that number is not total supply. It is a narrower measure, what is currently positioned to satisfy delivery notices through the exchange's process. And when you see delivery stops, like 633 contracts, you are seeing participants choose to convert paper into metal through that process. That doesn't mean a shortage is guaranteed. It means delivery demand is real enough that it is being exercised. Now add London. 27,818 tons in vaults is a massive stock, and it functions as the world's central pool for wholesale silver storage and financing. But wholesale silver is used for many purposes at once. Some bars are pledged against financing. Some are allocated to specific owners who may not want to move them. Some are tied up in products or in industrial supply agreements. The headline, stock is not the same as the readily mobilized float. This is where market dislocations are born because the paper system can reference a huge stockpile while the deliverable system is constrained. This is why the paper versus physical split is not a slogan. It's a structural feature that becomes visible during stress. Paper can expand rapidly because it is a claim. Physical cannot expand rapidly because it is a thing. Now, how was the late January move executed mechanically? It didn't require a villain. It required a fragile structure. First, price accelerates upward. That draws in momentum traders and leveraged participants. Second, volatility increases. Third, the exchange raises margin requirements to protect the clearing system from default risk. Fourth, those margin calls force participants to post more cash or reduce positions. Fifth, forced selling hits the market, often at the worst possible time, creating a waterfall. Sixth, the lower price triggers additional risk controls in funds and trading desks that are mandated to reduce exposure when volatility exceeds limits. That explains the candle. But it doesn't explain the split. The split comes from the fact that physical demand and physical availability operate on different timelines and constraints than futures liquidation. Industrial users may hedge on paper and source physical through long-term contracts, but they still care about refinery throughput and supply chain reliability. Investors may buy a futures contract for exposure, but physical buyers care about availability, premiums, and delivery time. In stress, those priorities diverge. So what does all of this mean going forward if the pattern holds? Historically, when you see a combination of three things, margin tightening, violent price swings, and steady delivery activity, you are watching the market test the boundary between paper capacity and physical constraint. One possible scenario is the conservative one. Volatility cools, margins normalize, and the paper and physical signals drift back toward alignment as speculative positions wash out and the market rebalances. A moderate scenario is more interesting. Volatility remains elevated, registered inventory becomes a focal point, and spreads between different forms of silver widen. The price becomes less meaningful as a single reference point because physical availability is priced through premiums and financing terms rather than through the headline futures quote. The aggressive scenario is the one markets try to avoid, a confidence event where too many participants demand delivery, or where a key financing channel tightens, forcing a rapid repricing of immediate metal availability. In that scenario, you can see abrupt changes in exchange behavior, in delivery incentives, and in regional premiums because the system is trying to keep settlement orderly. Notice what's missing here. There's no promise of a specific number. The point is not to predict an exact price. The point is to read the indicators that historically appear when the market structure is under stress. So what should be watched specifically? Watch margin changes. They are the exchange's way of telling you volatility is now expensive. Watch registered versus eligible inventory, because that tells you what is deliverable now versus what merely exists somewhere in the system. Watch delivery stops, because that tells you who is choosing metal over rolling paper. And watch the way big inventory figures are discussed, because large vault totals can hide a very small amount of truly available float. Here's the calm truth in all of this. Silver is a small market compared to global equity and bond markets, but it is deeply interconnected with industrial demand and financial hedging. That makes it a sensitive indicator. When it behaves violently, it is often reflecting stress in liquidity and leverage, not just in metal. The move from above 120 to 86.60 wasn't only a story about sentiment, it was a story about how quickly leverage can be repriced when the rules and funding costs shift. That's why this split matters beyond silver itself. It's a case study in how modern markets can show stability at the surface while pressure builds underneath. When the surface cracks, it happens quickly, and it surprises the people who were only watching the surface. This is the part no one is discussing enough. The real divide isn't between bulls and bears. It's between people who think the price is the entire story and people who understand that the price is a snapshot of one marketplace, at one moment under one set of rules. Those who understand this don't need hype. They don't need conspiracy. They simply track the system. They notice when a margin hike of $3,000 changes behavior. They notice when a day with 633 delivery stops represents millions of ounces moving through the settlement process. They notice when registered inventory sits around 104 million ounces because they understand that deliverable supply is the bottleneck, not the total metal in existence. And those who don't understand it will always arrive late. Not because they're unintelligent, but because they're watching the wrong scoreboard. They see the crash and assume the story ended. Institutions see the crash and ask a different question. What did the forced selling accomplish, and what did it fail to accomplish? Because if the paper price collapsed and the physical signals remain firm, the system hasn't resolved its underlying tension. It has only shifted who carries it. In every cycle, information asymmetry becomes a wealth asymmetry. The first movers are those who understand how the pipes work. The last movers are those who react to the headline after the mechanics already did their work. And in silver, the split between paper and physical is the most honest stress test you can watch, because it exposes where claims exceed immediate capacity. This is channel name, where we decode what matters before it becomes everyone's headline. If this connected dots you hadn't lined up before, you know what to do. And remember, the real question isn't whether volatility returns. The data already shows it can. The question is whether the signals are recognized before the market forces everyone else to notice.